What's up, everybody? Long time no see. A few months back, well, probably almost a year ago at this point, I put a poll out on the channel asking about interest in seeing my portfolio position. And I haven't been posting videos for a while, but I decided that that would be a great first video back after a pretty long break from the channel. I think in a way, putting the portfolio positions openly out there is a way to have a little bit of skin in the game. However, I may do this again. I may not do it. I think for the time being, it will be an interesting little experiment for me to capture the snapshot, and hopefully at least one of you will get some value out of seeing what's currently in my portfolio. So in this video today, I'm going to share the current construction of my portfolio, and that's going to be with a few caveats. And those caveats are, first of all, this is not financial advice. This is me sharing my portfolio for the sake of transparency. Secondly, please do not mindlessly clone any of these positions that are in my portfolio just because they're in my portfolio. Always do your own due diligence on any investments that you might make. I am not responsible for any choices you make in your own portfolio. I'm sure you're aware of that, but I just wanted to put that out here. So I'll briefly go over each portfolio position, talk a little bit about how I'm feeling about the position right now, when I purchased it, how confident I am in the position, and things like that. One of the big dangers of speaking publicly about positions that you hold in your portfolio is, number one, falling to commitment and consistency bias, which is the more you talk about something, the more you pound it in. And in some cases, I think I fell prey to that, and I'm still paying the price for it. So don't expect me to talk super in depth about these positions. This is just more of an educational type of experience. So with all that said, let's take a look at the portfolio as it stands today. I exported the symbols, the asset type, the current price, my average purchase price, which for many of these will include multiple tranches. So for example, Alibaba, I've made several purchases, some at much higher prices, some at lower prices. So that's kind of the weighted purchase price. Market value, that is blanked out. Sorry, guys. I'm not really going to share the dollar amounts at this time. There's no reason to do that. There's no obligation. I just want to be clear. This is the whole picture of my actively managed portfolio. I have an account through my work, which is basically just in an index fund. So this is what I'm working with right now. And then the total gain of the investment, which by itself doesn't mean a whole lot. It needs to be taken in conjunction with the overall slice of the pie. So that's why I've included both the table here and the pie chart. I'll just go quickly through each position. The top, starting at the top, they're not ordered by size or anything on this. So Tencent first. As you can see, Tencent's a tiny position. It's a 1% position. I bought this sort of as a dipping my toe in the waters type of investment. This was at the time that Monish Pabrai started to turn away from the Alibaba investment and was really starting to praise Tencent. I am a believer that actually owning the shares gets you a little more involved in owning the company. You never truly understand the company until you own it. On the flip side, having such a small percentage of the portfolio dedicated to this position isn't necessarily the best way to motivate you. So the good thing is that it's a tiny position that has slightly recovered lately, but I'm still down over 27% on this purchase. Next up, we have Seritage, which originally this started as a redevelopment real estate play with a bunch of valuable assets throughout the United States. And now it's turned into an asset liquidation play. The main concerns here are, when am I going to get my cash, and how much cash am I going to get at the end? So I've been adding to Seritage over the past year. Once they announced the liquidation plan, I got really excited about the company. At least there's a plan forward. Now, my average buy price, I was a little bit too excited with this. It was a little bit less than $15 per share. So I bought it too high, in my opinion. But I've been slowly lowering my cost basis. And the company management is aiming for somewhere between distributing $15 to $25 per share, something like that. This isn't going to be a big home run for me or anything. One of the lessons that I'm taking away from Seritage is buy price matters a lot. And while I may not get a donut on this, or I may, not lose any money, we'll see. The future still needs to play out. But if I had bought it down at, average buy price of $10 or $5 like Monash provided, I'd be sitting a little better off. But anyway, you live and you learn. The next one is a small 2% position. It's called Sizacam. This is a coke ash producer, which is a component used in glass production. That's not why I bought it. I bought it because it is a special situation. I think small cap special situations, nano cap, and micro cap investments are probably where I need to be focusing the most of my time. I think the small investor has a much bigger advantage in small special situations or really small undiscovered good companies, or even cigar butt companies. The world is the oyster when you don't have too much money to really move the needle for these big institutions. So anyway, back to Sizacam. It's a small position. I got this idea from Frank Taber's Lone Wolf's newsletter, which is a really great newsletter. Basically, the apparent company is trying to buy the rest of this company. They had a really low ball offer, and the thesis is basically that is going to re-rate to a higher purchase price. That's basically that. The next company is Nintendo. I made a video on Nintendo a while back, and Ryan O'Connor is a really thoughtful analyst who runs a hedge fund and sort of helped me get over the hump to take the plunge. And I know it's only a 1% position now. It's been not a wonderful performer. I'm down almost 30% on the position. But again, it's only a 1% position, so it's not really that significant. I think Nintendo has some of the best IP in the world, some of the most valuable IP. And it's a company built, in my opinion, to last well over the long run. I'm not sure why I don't have more of my portfolio in this company. Mostly it's because there are some things, I'm finding it hard to see catalysts that will unlock value faster than I want them to, basically. I think it's a great long-term general to hold in the portfolio. And I'm saying all of this with it at a 1% position. So take everything I say with a grain of salt. Actions speak louder than words on this one. So it's a company that I want to be a big portion of my portfolio. I definitely think Nintendo is severely undervalued, but I'm not sure when that value is going to be unlocked and how long it'll take. That's a little harder to predict. So this, in my opinion, to be kind of a general that I would want to keep in the portfolio for a long time and sort of set it and forget it. Next up, we have Micron, which is my largest position. I have an average purchase price around $41 per share. I started looking into this company when I saw that Monash Purbright had purchased it, and it was a significant purchase for the Purbright funds. I think it was a full 10% bet, which is pretty meaningful. It's been a pretty good performer at 41% gain overall. However, it was up a lot more during the past couple years. It got over $90 a share, something like that. But I just held on to it, didn't do anything. But I believe at $90 per share at the current price of $58, definitely undervalued. It's basically a tax on all data centers, anything that has short-term memory chips in it. This is one of the generals that I'm going to keep in my portfolio. I think it's cheap on an asset basis. I think it's cheap on a future earnings basis. And it's unlikely that I'll do anything with this position. Just let it ride until I think it gets egregious. Next up, we have Marathon, MRO. My investment in this is probably the best percent gain that I've had at almost 600% gain. It's kind of ridiculous to think about that. The sad thing is that it's only a 13% position in the portfolio after a 600% gain. So that tells you how tiny of a portion of the portfolio I made this when I purchased the investment. Basically, the story behind this one is in the depths of the COVID crash in 2020, I was looking for blood in the streets, as they say. Marathon was selling at a quarter of book value, and I just decided to dump, I don't know what it was, 1 or 2% into the portfolio. At that time, I also was buying more Micron as well, so I was trying to decide how to allocate that appropriately. And well, I should have put 100% of my money into Marathon. I think it's been one of the best performing stocks of all the stocks, at least in the US. So there's a solid capital allocation process going on there, good dividends. Management seems to be rational about not going too heavy into more CapEx, unnecessary CapEx. So as long as management stays rational, I think I'll keep this puppy in the portfolio. Next one, this is probably my most hated position. I totally regret buying it. I'm still holding on to it. I do think that Meta is undervalued at the current prices, but I purchased it and then they announced the Reality Labs initiative. That's when I should have sold it, even if it was at a loss. Yeah, I should have sold when the thesis changed. There's a small chance that I could add to this position, but I may just... This might be another candidate where I just want it out of the portfolio for good. Next up, we have Harbor Diversified, which is a small cap airline, regional airline. I did make a video on Harbor. It was one of the last videos I posted last year. Basically, there were concerns for this company as a going concern because they had not renewed their contract with United Airlines, which was the airline that they basically flew under the banner for. It turned out that they actually did negotiate a new contract with American Airlines, so now they represent American Airlines. Basically, I think this company is cheap on an asset basis. They now have little concern about the ongoing business operations, so there's asset protection on the downside. And yeah, I think it's a cheap company. It's not the best company. It's an airline. Some of their costs are covered by American, which is good. But yeah, this is more of a cigar butt type of liquidation play. Next up, we have Gannett Corporation. This is the owner of the USA Today newspaper and a bunch of other regional and local newspapers. USA Today is, I don't know, the third most circulated behind the Times and the Wall Street Journal. The main thesis of this is probably not that surprising, but one, it's the turn from physical newspapers to digital subscriptions, and the other is they have a budding digital marketing solutions platform. So they have a bit of a two-pronged approach here. The biggest concern with Gannett is the debt load, but I think it's manageable. I think the interest rates on the upcoming loans should be covered by free cash flow. Again, this is a small position, testing the waters to see how this goes, how something with a lot of debt that hopefully will be covered by free cash flow goes. This idea, I learned it from Bill Miller. Bill Miller has it in his personal portfolio, I think, and he also has it in the Miller Value Trust. This is definitely a cigar butt play. A pretty bad business, a newspaper business, trying to transform into possibly a good business. But there's no doubt that this company is super cheap on a book value perspective. So the next one is Bank of America. This was purchased during the COVID crash too, I think. It's probably the best retail bank in the United States, according to Warren Buffett. But Warren Buffett owns this. Li Lu owns this. I'm sure another handful of prominent value investors own this one. But there's not much to say about this. It's a well-run bank. It seemed cheap on an asset basis when I bought it, and I've just been holding on to it. Decent return on it. However, it's not the most compelling position in my portfolio, so it could possibly be a candidate for sale. And there are some other, even if I wanted to replace it with another bank, there's some other candidates that I might prefer to that. So, okay, these last two are pretty big. Let's go with Alibaba. This is my second largest position, and it's also been my biggest loser on a a dollar basis, this has been one of the more painful positions of my entire time investing. As you can see, my average purchase price is 192. The current price of the stock is about 115. It's probably gone down this morning for all I know. That's the way things go with Alibaba. This is one of those ones that's been the biggest pill to swallow for sure. I haven't sold any, but I bought in too early, and there were a lot of things that happened to this company. I think it's a wonderful company with a lot of competitive advantages, and then there was government pushback, government crackdowns, the whole Ant Financial fiasco. Cloud is doing okay, but it's not doing as well as I would have liked. COVID lockdowns in China, just general sentiment towards Chinese tech stocks in general, interest rates rising. So there are a whole confluence of things that some of them were unknown unknowns, some of them were known risks, and they kind of all in a flurry happened at once. So this is one of the main reflections of the past year, that I probably had an over-reliance on the power of Charlie Munger investing in Alibaba, and he's also lost his shirt, but it's probably not bothering him. I haven't sold anything. I do think it is a good business that I would want to hold long term. I just would prefer if my average price, my average purchase price had been today's price and not, 2 years ago or whatever. But again, you live and you learn. I would like to try to lower my average cost basis in this one, but it's already a pretty large position in the portfolio. And as I've been saying, I want to try to get away from large cap investments in general. I think there's more alpha to be had in smaller companies. The bottom line is, I think I ignored too many risks with Alibaba, and it's been a wonderful learning experience, learning about myself, how I react when my stock is down 50%. And I think that's par for the course. And it's already happened to me, which is kind of, fine. It's a good lesson to have early on. With this one, I also kind of ignored valuation. Not ignored, but I didn't pay attention enough to it. When interest rates change, the value of equities changes. So when interest rates rise, the values of equities typically go down. That's part of the reason why Alibaba has gone down. And I should have been more disciplined, and I wasn't disciplined. And maybe I should have sold when Monish Prabhai sold, but I still felt that the business was undervalued then. And I know I don't have to make it back the same way that I lost it. And that's a mental hurdle that I'm trying to overcome. The final one is Apple. This is the oldest position in my portfolio. I've had a very good gain on it, 460%. And again, this is a similar thing to Marathon, where it was a small portfolio position. I bought this at 2015 or something. I don't think there's too much to say about Apple. It's the largest company in the world. It's one of the most valuable products from a mind share, time share perspective from an individual, how much time you actually spend looking at an iPhone, iPads, MacBooks, and the like. And then they've expanded into accessories like this AirPods, services, recurring revenue services that make the ecosystem all that more powerful. A great network effect, great product, something that I use personally. So this is kind of more of a Peter Lynch style investment. It was something that I noticed I was using a lot. It looked fairly cheap, sort of on an earnings basis. And yeah, I went for it, and this one has worked out. So the only trouble with Apple is I don't know how long I can hold it with my current understanding of where the business will be in 20 or 30 years. I just keep saying to myself, I'll sell it when Buffett sells it. Selling is the hardest part, so maybe I'll offload it to whoever's running the Berkshire portfolio at that time. But if I do need cash, Apple sadly might be one of the candidates, although I'd like to hold it forever because it's really hard to see Apple going anywhere anytime soon. And then finally, cash. Cash is a little bit of a weird thing in this portfolio because I just add cash when I need it. There's not much to say about that. I think I'd like to be as fully invested as possible. And yeah, that hurts on the down when the market goes down. But yeah, it's better than the alternative to me, which is giving up the opportunity to own assets for the long term, or even assets for the short term. Maybe you see a lot of these smaller positions are more cigar butt style plays. So we'll see how they go. And that's basically that. Again, this is just for transparency's sake, and it's a little bit selfishly. Hopefully I can look back at the end of this year, maybe at this video, and see where things have gone. It's nice to have a bit of a paper trail. Do not clone me in any of these positions. Clone great investors. I'm just trying to impart some of the lessons that I've learned managing and thinking about my current portfolio. Some of the joys and some of the pains. Again, not financial advice or anything. Please, please, please do your own research into any investment that you make. With that said, I hope you enjoyed this video. I surprisingly enjoyed talking about the positions. Yeah, it's good to sort of verbalize, especially the painful lessons, because those are the ones that I learn the most from. And let's hope that these are mistakes that I make early and with smaller amounts of capital. That's the goal. So keep trying harder. I hope that you have a wonderful 2023, both investing and personally. Thank you all for watching this video so much. If you liked the video, please like the video and subscribe for more. Have a good one. Thanks a lot.